In today's video, we are going to look at a case study where an individual is looking at policies for his entire family. Now, it's not a large policy. It is him, his wife, and his daughter, so 3 individuals. But this will be a good case study if you're interested in policies for your family and really what questions should you ask or what should you be looking for when you're looking at a policy for yourself and then also a policy for your children. Are there differences there? Maybe you want a policy for yourself where you fund it with a large amount of money, but for a short period of time. You'll see a couple examples in this video for the husband or for dad, where he only wanted to pay into the policy for 5 years. Then for his daughter, well, he wanted to be able to pay into the policy for a long period of time because she was younger. So to get right into it, as we look at the details here, we've got dad at 52 years old. We've got mom at 45 years old, and then they have a daughter who is 12 years old. And he's interested in policies for all 3 individuals. We did discuss different companies and products during our call, but he's relatively new, relatively green to everything, and really wants to make sure that he is shown the best possible option. So what dad is interested in is 1, policies for himself and his family, so call it personal policies, but then 2, also for business use. He's very interested in being able to use these policies for his business. Him and his wife own a company together, so their plan is to position the cash value as an asset on the company's balance sheet. Now, with that said, he might decide to own some policies through the company, or what he can also do, and you can do this if you're planning to own a policy through your business, is you can own policies personally. And then if you are a 100% owner of a business, you can assign the cash value as collateral to your business and receive a business line of credit from a bank, from a third party. You can even use policy loans direct with your business using personal policies. There's ways you can assign the policy as collateral to your company. Some people do that, some people don't. It's a nice option to be aware of. I like it. I do it with some of my policies, but again, it's a nice option to be aware of. Continuing on here, what we looked at in his situation, first and foremost, was how much would you like to fund a policy with each year? And he wasn't sure. So what we're starting with are options of showing what a policy would look like if he pays $25K per year, $50,000 per year, and $100,000 per year. So that gives him a nice range as far as options. And a key word I forgot to mention here or add in this text was how much does he want the ability to pay into a policy on any given year, not commit to. For example, if he selects the $100,000 per year option, that does not mean that he is obligated to pay $100,000 per year. He can pay up to $100,000 per year, but he's committed to just about $10,000 per year, slightly more than that. But a policy can be designed with a minimum commitment and the ability to really shovel more money into the policy at discretion. The next question we had here was, how long would you like to fund the policy? Unsure. So to provide some awareness here, because if you're in this situation where you're trying to figure out how much you want to pay into the policy, how long you want to pay into the policy, this was a perfect case study just to work with someone who has an idea of what they want, but they're unsure on how much and how long they want to fund the policy. So the first thing to do is ask some questions. Well, if you're unsure how long you want to fund the policies, for you, Dad, you're 52 years old. Would you want to fund the policy for 10 years? Yes. Would you want to fund longer than 10 years? No, the chances are slim to none that I want to fund longer than 15 years. Even longer than 10 years is unrealistic. Well, to provide some awareness to you in that case, if we were to look at shorter funding periods, particularly 7 years or less, you will see the highest internal rate of return. For example, it's very common to see individuals who have a lump sum of money, if it's just sitting in cash or another asset that they want to put to work for themselves, they'll move it into a policy. For example, if I have a lump sum of, call it $500,000, I may move it into a policy over 3 to 5 years. My age will have an impact on the most efficient time period, but I can move it into a policy and then never make another payment. I've got the option to continue to add to it, but it's very common to see individuals say, here's my lump sum of money. I want to move it into a policy quickly and then be done with it. I just want to see it appreciate and then be able to access it like a personal line of credit and have the life insurance death benefit as well. So if someone's in that case or in that situation, a nice advantage of the receiver of benefit is a very high internal rate of return. Now, on the flip side, funding for a short period of time, if I only want to fund, call it for 3 years, or maybe it's 7 years, I'll see a higher internal rate of return, but it's only on the amount of money that I get into a policy over a short period of time. Whereas if someone says, I want to fund a policy for as long as possible, more than 7 years, well, what we'll often see here then is a lower internal rate of return, but on a larger bucket of money because you're continuously adding to that pile of money. So a way I like to illustrate it is, would you rather have 5% as far as an internal rate of return on $500,000 or 4% on $1 million? Well, often people say 4% on $1 million. But then of course, if someone says, all I want to get into the policy is $500,000 because that fits what I want to do, well, then we want to show them how to maximize that. It's really just making sure everything fits one situation. Company selection. So when it comes to company selection, it's no secret that we always talk about the 4 major mutual companies: Mass Mutual, Guardian, New York Life, and Northwestern Mutual. So when it comes to those companies, without getting into all the nitty-gritty, Mass Mutual, we can easily make payment adjustments 1 time per year. Guardian, we can commit to the minimum and throw excess funds into the policy at leisure via PUAs. To really hit the sweet spot with the products that are available with these carriers, if someone said, I want to fund a policy for a long period of time. Let's say, for example, the policy for my daughter who's 12, I want to be able to pay into this thing for 50 years, or I want her to have that option. I'll fund it for the first 10 or 20, and then I want her to be able to continue, and I just want to keep on feeding the beast. She'll be 62 years old at the end of 50 years. Can I do that? The answer is yes. And with Mass Mutual, you can actually set it up where we have a 10/90 split. And what that means is 10% of the payment is directed toward the premium. Everything else is allocated toward PUAs to maximize cash value. So you have very high upfront cash value and strong long-term performance and flexibility. We can really get everything. So to hit on what I mean when I say that, if you wanted a long funding period for your daughter who's 12 years old, if you want to be able to feed that policy, call it for 50 years, and you're going to see examples with $5,000 per year, what that means is we can have a policy with an approximate $500 premium. We'll add term insurance too. That might be another $100 in this case, but a minimum premium. That, by the way, is your minimum commitment. The net that we might be committed to might be between $700 and $750, but still a minimum commitment. And then with the ability to plow everything else into PUAs to maximize the cash value and see it begin to grow immediately. Now, a quick side note on that premium piece, you will see premium dollars show up in cash value. I have a 0 here. Typically, it's a 0 only the first year. We're beginning the second year with some products. I'll see that premium come back to cash value for me. With some products, it's not until the 3rd year. You're going to see a high early cash value product in this case where you see 80% of that premium show up in cash value right out of the gates. So it's cash rich up front, also cash rich long term. So that's one example here where we've got a policy with a minimum premium and you can pay into it for a long period of time. Now, if you want to fund a policy for a shorter period of time, I would recommend Guardian. So for Dad, who's 52 years old, when we looked at different scenarios, we looked at a 5-year funding option for him, which he can go longer with the same policy. But with Guardian, what he can do, let's say he picks the high-end option here, option 3 for himself. I want the ability to pay up to $100,000 per year. Well, what that would look like here is he would have a base premium. The actual base premium is just about $9,100. He's got a term rider. It's a little bit less than this. I'm just going to round here, of about $2,000. So when you add those two together, you're a little over $11,000. Let's call it 11.1. That is his minimum commitment. That's what he must pay annually. He can break that up over 12 months as well. In the first year, with the Guardian product we're going to look at, nothing shows up in cash value. However, beginning the second year, you will see that premium come back to cash value. So what he has in this case is a policy where he's committed only to the minimum. This is what he's required to pay each year. He does plan on adding more funds to the policy into PUAs. Call that another $90,000 per year. Technically, it's about 89, right? If my net payment is 100K, you see where I'm going here. Everything else in the PUAs, which I see in cash value immediately. So the name of the game is how do I minimize expenses and maximize the cash value. Also, when I can build that flexibility in, it puts me in a position where the policy never feels like a burden. The last thing anyone wants is to have a policy where I can pay up to $100,000 per year, but be committed to $100,000 per year. Maybe I'm committed to a $20,000 or $30,000 base premium. The lower I can drive that commitment, the more flexibility I have, and also the more cash value I have, especially on a guaranteed basis. And then that MEC limit, which is ensuring the policy does not become taxable, we've got set at $100,000 as well, which means we can pay up to $100K per year. And how we set that MEC limit is with the total death benefit. You'll find that the MEC limit has a direct relationship to an individual's age and total amount of life insurance. You're going to see kind of oddball death benefits as we go through the figures. Well, let's get on into it. So, beginning with Papa, we've got a Guardian L95 policy here. And what we've got are the three options here. So the neat thing about this is we've got all the same option or similar policies side by side. We see on the left, $25K per year for 5 years. So this is a policy that has a minimum base premium and a maximum payment of $25K per year. And this demonstrates what the policy looks like if he pays $25,000 per year. Break-even point is highlighted in yellow between years 5 and 6. If we look at the next option, $50,000 per year for 5 years, a total of $250,000 paid into the policy. Look at that break-even point. So close in year 5, you're at $249 and change. But technically the break-even is between years 5 and 6, and that's based on the present dividend rate, the non-guaranteed values that is. But before I continue, look at those death benefits. Look at the far left, you're at $380,000. Where we came up with that exact dollar amount is for a 52-year-old male. That gives him a MEC limit of, guess what? $25,000. If we work with someone, if we're working with you and you say, I want maximum cash value, let's minimize the death benefit based on this dollar amount. Here's how much I want the ability to pay in, not commitment, but how much I want to be able to add to the policy. If it's $25,000 per year, and you're a 52-year-old male with a product with a guaranteed rate of 3%, the guaranteed rate has an impact, but we can continue on. We would need a death benefit of at least $380,000 to achieve that. Multiply that by 2, 380. What do you get? $760. Death benefit doubled. Guess what else doubled? MEC limit is now $50K. Double it again. Guess what? 1.52. Paying in up to $100K per year. MEC limit is now $100K. Check that out. Death benefit will always be proportionate to the MEC limit. If I double the death benefit, the MEC limit will double. The initial design, aside from the MEC limit, is the most important piece. Where's my money going? How much toward premium? How much toward PUAs? What's the term rider cost? When we break down illustrations. When we look at this option, 100K goes in. Worst year is the first year. I've got just about 83.5. Which, no matter how I slice that, that's a loss of about $16,500. That's the pain point. If someone asks, why would anyone not do this, take out a whole life insurance policy? It's going to be the first year. No matter how well the policy is designed, that's where I've got that negative hit because of the base premium. We try to minimize it. We always want to maximize upfront and long-term cash value, but just minimizing that as much as we can. With this particular product we've got here, that's as low as we could drive that upfront hit, 16.5, which is a lot. Now, beginning year 2, you'll notice you're paying $100K again, Do you get your full 100K back? Almost. If you got the full 100K though, it would have been worth 183,466, but it's 181,525. Beginning the third year, you pay in 100K and you get that full 100 back. And by year 5, look at this, man. We should have ran it Preferred Plus, the top health class. We could have got a break even in year 5. We're very close here. Just about year 5. In year 6, he's positive. He's paying nothing in beginning year 6. He just gets $500,000 in and lets it ride over time. Why that death benefit drops at year 8, and you might recall on the points of awareness, funding for 7 years or less does maximize the internal rate of return. Well, what we exercised here is referred to as a reduced paid up option, which eliminates the premium altogether, but it also drops the death benefit and maximizes the cash value growth. Let me show you something here real quick. And this is just an annual internal rate of return, meaning not the average. There we go. So look at the first 5 years when I'm paying it. First 2 years I'm negative. Then if I've got a positive IRR, that means the policy is growing by more than what I pay in. And then years 6 and 7, I'm not paying anything in. So there's no premium loads. There's no PUA fees. There's less drag on the policy. But then it takes a nice jump here from year 7 to 8 when we drop the death benefit. We also eliminated the base premium. Year 6 and 7, the policy is paying for itself. So there's your IRR. We can go further down if we'd like. It just isolates it on an annual basis. Can also, if you prefer dollar amounts, look at the cash value growth. And anytime we look at the cash value growth, what I'm interested in is the net growth, meaning I want to exclude my premium payments. That doesn't count. So always back out my payments. And this shows how much in dollars my policy is growing by each year. Pretty cool, right? Just to get transparency as far as how much did my cash value grow by each year, which I just like the transparency, especially up front. Like, get the negative part out of the way early. Don't try and hide it from me. So that's Guardian policies based on the dividend rate. Then we've got the indexed feature rate, which just adds a little bit greater earning potential on a whole life insurance product. We do have some content on the indexed rider with Guardian. I would check out the video above, which just goes through the indexed feature, how it works, fees that are associated with it and such. In short, it does grant a little bit greater earning potential on a whole life insurance policy, but it is a rider that you can attach to the policy. So if you attach it and never use it, it's the exact same thing as if you never had it in the first place. You have a basic dividend policy. But you will see on the IRR, and you'll see this consistent with both options here, it does grant a little bit greater earning potential, which does not hurt. However, this is all hypothetical here. We do like to look at conservative numbers. While this is aggressive, conservative would be the guarantees or conservative dividend. But that's the same thing, funding 5 years. Let's look at mom here. So with mom, what we looked at here was a 15-pay policy. She's 45. This will allow her to make payments for 15 years. And we did the exact same thing where we've got funding for or funding of 25K per year, 50K per year, and 100K per year. Now what she can do as well, let's say, again, she picks the high-end option of 100K. If she were to do something like this, funded it 100 years 1 and 2, and then 50K some years, and then 25K, and then back up to 50K, and then 100 a couple years. She can do that. With Mass Mutual, payment adjustments can be made 1 time per year on the premium due date, which is the anniversary date, without any medical underwriting. But you will find with Mass and Guardian, most situations, if someone's able to max fund the policy really in the first and second year, you put yourself in a position where you'll see the break even almost always between years 4 and 5. In most situations, if I've got a poor health rating, or if I'm a bit older starting a policy, it might be pushed out a little bit later. But if you do things right, and I'll always show you what do things right means. It's similar to this, but if I reduce the funding afterwards, what's the likelihood of me still hitting that break even early? Now, one thing you may have noticed here too, look at that first year cash value. 89% right out of the gates. This product does have lower PUA fees. She also starts at age 45 here. At the end of the first year, she's 46 in this example. More cash value up front and strong cash value long term as well. So this is a pretty cool option when I look at the upfront liquidity, especially if he's interested in using this for his business. He might elect to go with both policies with MassMutual in order to get more cash value up front, particularly as an asset on the balance sheet. But looks good short term, looks good long term as well. The internal rate of return will be attractive. Shall we take a look? I think we shall. It's fun stuff, right? Now, this is one of my favorite things to do, actually, modeling the policies, building them out, and then actually talking through them with individuals, answering questions. It's always been my favorite thing to do. There we go. And this is just MassMutual's present dividend interest rate. One other thing I wanted to hit on with Mom was this. Here's the 50K option, but it shows a what-if scenario. What if I don't fund it for the full 15 years? Because we did say you do not have to. So here's the option that we just looked at. If you fund the policy for 15 years, looks fantastic, break even between years 4 and 5. But then here's the exact same policy, but stopping after 10 years. Or what does it look like if I stop after 5 years? Maybe I start with this plan, but I decide I want to keep going. So a policy can be designed to do this. And this is a policy that has a minimum premium of $5,000. Continue to pump money in, and it looks fantastic over time. All based on the present dividend rate, which we do have to run dividend adjustments, look at conservative numbers, but this is exactly what we want to see here. But what if scenarios, I love, love, love showing them because I don't want to find out after the fact I can't do something. Let's wrap up with the daughter scenario. This will be fun. So what we've got here, similar to what we just looked at, the 50K for 5, 10, and 15 years. The difference for the daughter, we've got a lower dollar amount, $5,000 per year on all three. The difference is funding it for 10 years, funding it for 30 years, and funding it for 50 years. How long can you go? Well, we can go longer than 50 years if we wanted to. Here's what I want to hit on. When you look at years 4 to 5, what is the break-even point? The same on all three. When you look at year 10 on the left, or let's say year 10 across the board, do you see any difference in the cash value? No, because they're all the exact same policy. The only difference is this. In this option, we stopped payments altogether. If he chooses to do that at that point in time, you do not need to declare upfront how long you want to pay into the policy, particularly with MassMutual policies. We can set them up. With Guardian, we need to know a little bit more as far as how long you might want to pay in and how long you want to be able to max fund the policy. But as we scroll down here, what do we see? Well, here's the 30-year option. Here's the 50-year option. You can adjust the dollar amount too, but that's a nice pile of money with adding 5K per year. But as far as options, so what we're trying to do here is keep things simple. We've got one Guardian option for dad, one product, I should say, with 3 different funding options, and the dividend and index are exactly the same, just exercising that indexed rider. So I really just have the 25, 50, and 100K option. With Mom, same thing, 25, 50, and 100 for 15 years. But here's a demonstration with 50K and what it looks like if you fund for a shorter period of time, since you have the option to do that. And then for the daughter, just one option, but displaying what it looks like if you fund for 10, 30, or 50 years. So I had a ton of fun with this one. I hope you enjoyed it. If you did, please hit the like button, subscribe for more. If you have any questions, please leave them in the comments below. I do try to always look at those. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.